Hi, Sean Wolin with the Wolin Mortgage Team here at Waterstone Mortgage, here to talk about how mortgage rates work. First of all, mortgage rates are actually a reflection of the yields of bonds. So when you look at the bond market and if it's having a bad day, rates are going to have a bad day on mortgages. If it's having a good day, rates are going to be good for mortgages. And they can really go back and forth multiple times a day and change quite frequently. But rates, the way they work when you're pricing a loan, when you're getting a loan, I want to talk about the points and the discount points of what they called origination points or lender credits. How do those work? So basically, if you look at a mortgage rate sheet, there's going to be a point on the rate sheet where a rate costs zero. And then there's going to be negative below it and positive above it. So the positive, if you get a rate above 0 points, any of that positive, the higher you go, the more money the lender can give you towards lender credits. And that's how no cost refinances are done. And that's how lenders pay for fees. And then the opposite is true as you go down. The lower you go, the negative numbers get bigger and bigger, and that's a cost. So the lower you go on the rate sheet, the more it's going to cost you. And that's what discount points are. So it's almost like a temperature, like a thermometer. There's a 0 degree mark. There's a 0 point where there's no points. And then there's rates that go all the way down and rates that go all the way up. And that 0 points, it varies all of the time based on the cost of rates. So when somebody gives you a quote for a rate that sounds too good to be true, most likely it's way down on the scale and there's points involved. So if you have questions on how rates work, or if you want to lock in an interest rate on your mortgage and you want to make sure it's done right, give me a call and I'd be happy to help.